when you have to take the sell-off last week into context and put things, we're still up an average of 12% in the average stock in the S&P 500 this year. What's even more surprising is, despite the fact of all this worries about global weakness in the global economy, stocks with the most international exposure are the ones doing the best this year. The 50 stocks in the S&P 500 that have the highest international exposure are up close to 20% this year on average. So you've seen some real strength in these stocks, and it suggests that maybe as bad as the headlines are in Europe and the rest of the world, maybe things are going to get a little bit better.
I think that's important. So repeat that. Companies that have higher global exposure have done better.
So the largest of the multinationals have done the best. They've averaged an average gain of just under 20% this year.
Hardly screaming global slowdown.
No, and I think when you look at other periods, when you see negative economic headlines, we saw negative headlines in Japan 2 weeks ago. When you look back at prior periods where we saw that real weakness in the headlines, longer term, it proved to be a good entry point.
Do you think that can continue?
I think a lot of this does have to do with the yield curve. In your prior segment, you were talking about recession risk of a yield curve. The importance of the yield curve is how long are we going to be inverted for? Because when it first inverts, the market performance has been positive. But if you look at all periods where the curve's inverted, it's weaker performance.
Hugely important point you are making right now. And I want everybody out there to listen up to what you just said. It's not if the yield curve inverts that causes doom. It's if it stays inverted.
Yeah, I think so. So the longer you have this situation, the more that the higher the risk goes.
And where do we stand right now? What's the risk level right now?
I think if we can go a few days inverted and then start to steepen again, I don't think the concerns are as worrisome. I think when you focus on the market, our big area of focus is the semiconductors, and they've been a great leadership for the market overall over the last 6 years. Every major sell-off in the stock market has been preceded by underperformance.
And what are semis telling us right now, Paul?
As of Monday, or as of Friday, their relative strength was at a new high for this current rally. So
it's green. It's green on the screen.
They haven't rolled over yet.
Paul, thank you, but stick around.
You.
We're going to do something we've never done before.
Uh-oh.
Time for your morning RBI, the most random but interesting thing you're going to hear all day. And today it comes from this guy named Paul Hickey from Bespoke Investment Group, who just happens to be sitting beside us, because I thought this was a good enough stat that it would be so random but so interesting. And this is the stuff that you guys, I think, do better than anybody else. Going back, 70 years or whatever tracking data you've done, when the S&P has a down more than 10% quarter, as we just did in the fourth quarter of 2018, what happens?
Well, you've seen very strong responses in the market overall for the quarter after, the next 2 quarters, and the following year. You've seen the average gain over the next quarter is about 6 or 7%. Over the next 2 quarters is over 10%, and over the next year is about 15%. Longer term, better than average returns. And what you've seen is, the point is that 10% decline in the stock market in a quarter is not a common situation. It's usually a shock to the system where you tend to get an over-exaggeration, and then as things settle down, investors come back in.